What's up everyone, Dylan here. I wanted to hop on for a quick analysis video coming into a very eventful week. So this week has the potential to have a ton of volatility as there's a lot of moving parts and a lot of key events to look out for. So some of the key events include tomorrow CPI at 8:30 a.m. Eastern Time, Wednesday PPI at 8:30 a.m., Thursday jobless claims and retail sales at 8:30 a.m., Friday, we have consumer sentiment at 10 a.m. We also have Vixperation on Wednesday. What does that mean? That means that the current spot VIX futures, which is the July contract, expires and VIX rolls to the August contract. We also have July OpEx, which stands for options expiration, on Friday. So these are different events that have a lot of moving parts and the potential to create increasing volatility. On top of those, we also have the start of earnings. So tomorrow, before the open, we have some big financial institutions reporting earnings, right? JP Morgan Chase, Citi, Wells Fargo. The following day, Wednesday before the open, same deal, Bank of America, Goldman Sachs. And then Thursday, we have the first big mega cap tech name, which is Netflix. So Netflix is very important as it's in the top 10 holdings based on market capitalization within the Nasdaq. So again, there could be a increase in volatility this week. Okay, so let's get into current action. So last night, the futures, the S&P and the Nasdaq were seen gapping lower upon the Sunday night reopen. Because Trump came out Saturday and said that the Mexico and the EU are going to be slapped with 30% duties at the start of next month. So that was perceived as bearish. But one thing that is very clear is each time this market pulls back, the bulls are able to scoop the pullback and push value higher going forward. So in other words, we really have not seen sustained pullbacks that have legs. So there's really not much of an argument in terms of any scenario that bulls don't have control, right? The bulls are clearly in control as the S&P is able to sustain value near all-time highs. Okay, so right now it's taking a breather, as you can see, since, say, July 3rd, it's been moving sideways for the most part. But breathers are very healthy, right? Breathers, what is it set up for? It sets up for the RSI to take a nice, little breather again, right? So the RSI pulling back as the bulls are able to sustain value and consolidate, that is bullish. So here are some key areas that I am looking at going forward to kind of get a sense of which side has control. Okay, as of now, again, no argument, the bulls are in control. However, there could be some increasing volatility if this support were to get breached, followed by the ability for the sellers to keep price below that black line. Okay, so a bullish scenario would be a break below and then a very quick recapture up, which would factor in new sellers, and that would be basically a bear trap, and it would cause those late shorts to get squeezed out. Okay. However, if that black line fails and then you see that the sellers start to reject price from getting back above there, right, that could be a potential move to the downside. So again, I would definitely keep an eye on that black line and to watch price action around that. And if the sellers are able to push value down and keep price, right, keep rallies, keep a lid on rallies below there, that would be bearish near term in my opinion. Okay, so that line sits right around 62.65. So 62.65 is going to be very important going forward. The bulls do not want to lose that support, and if they do, and they're unable to retrace or recapture back above in a quick manner, I think that the market could ultimately sell off down to 6,200 on SPX. So 6,200 on SPX is very, very important, and I am going to show you why. First off, that is where the market bounced, what was that, last week, right? Last Monday, the market came down right into 6,200 and bounced. So A, it's a support level from last week. B, it's a psychological whole number, right? A lot of option strikes are tied to those whole numbers. So with dealers hedging against strikes that have heavy open interest, you'll tend to see some nice support there, or resistance, and vice versa. So this is spot gamma. I posted this in the Academy chat last Tuesday. I said next week. Now when I say next week, I'm talking about this week. So this week could well be a turning point given the slew of data, OPEX, end of month FOMC, and the August 1st tariff deadline, right? Which is where implied vols peak. As Spot Gamma notes, this doesn't have to be a point at which the market drops sharply, but the conditions will be ripe. The argument is that these are all second half of July problems, and zero DTE traders can come out and attempt to harvest vol until then, which they have. I'll get into that. In the short term, Goldman's Nelson Armbrust highlights something crucial for all traders, not just zero DTE maniacs. It's been a while since I wrote about Gamma because it has been flattish for a few months now versus a historical long of 4 to 6 billion. Well, now the market is short $3 billion worth of Gamma. This large negative Gamma profile exacerbates market moves and therefore increases intraday volatility. So all that means in terms of the negative Gamma is that when the market moves up, the dealers chase that up move. When the market moves down, the dealers chase the down move in order to hedge their positions. So because they're chasing, it adds to the momentum. So especially on the downside, if the market does pull back and sell off with negative Gamma, that just exacerbates the move, makes it quicker, makes it more aggressive, more violent. Okay, so that's all that means. So this is where it gets into this, right? Finally, Spot Gamma sees 6,300 SPX as resistance. We have not hit that yet. And 6,200 to the downside. They said at any time from now through the window to the end of the month, we will flip to risk off if SPX breaks 6,200, especially because negative Gamma environment. Okay, so that's very, very important. And then on top of that, there's also some CTA models from Bank of America, and there's some key levels as well for that as well. So 6,200 SPX and 22,600 for the Nasdaq. 22,600 for the Nasdaq is important as well because you see a triple bottom support at that line, and that's where Bank of America says that the sell trigger lies. So if I click here, you could see Nasdaq's the second one down, and you could see right under sell trigger range, the selling for CTA starts at 22,604 as per their models. That doesn't mean that it's going to definitely happen, but it doesn't hurt to keep an eye on it, especially because it has acted as triple bottom support. What was that? 2 weeks ago. Okay. So to the downside, if S&P futures breaches 62.65, the next two levels down would be 6,200 SPX, and then beyond that would be 22,600 Nasdaq. If 22,600 breaches on Nasdaq, and then the sellers again keep a lid on price rallies below that, right? That would be ultimately bearish for the market. I think that's when the market really kind of flips in terms of volatility increasing and the sentiment flips from buying the dip to selling the rip. Okay. So again, just because it breaches doesn't mean it's automatically going to sell off. It could result in a quick recapture back to the upside, which would ultimately be bullish, as that is a bear trap. However, right, if the market does breach that and then you see that sellers start to reject pops back into that general area, that would be a bearish piece of information. Okay, so to the upside, or not even to the upside, but as long as 62.65 holds, right, as long as price stays above 62.65, the bulls have control. Okay, there's, again, not much argument there, right? We're so close to all-time highs. Every single dip keeps getting bought. Volatility is still subdued, right? You can see volatility is kind of just going sideways at contract lows, right? This is the lowest the July VIX has been. So again, because volatility is subdued and the S&P keeps getting bought on dips, the bulls are in control. But below 62.65 is where I start to pay attention. Another thing that's worth noting is that on Thursday, there was a large MOC imbalance order. So Thursday at 3:55 p.m., I said today was the biggest MOC to sell side I've seen in some time. It was $4.1 billion to sell. So the big ones recently have been to the buy side. Keeping an eye on this going forward to see if the tide starts to shift to change direction. So essentially, the fact that just this happened 1 week before Vixperation, OpEx, and all of these other events is something to keep an eye on. So as you can see down here, I only look at the abnormalities in terms of the MOCs. So for example, if I see 10 buy side MOCs in a row, right, each day is a buy side, and then the 11th day I see an abnormal outlier, right, where it's a massive sell side imbalance, that tells me that something is occurring behind the scenes. And you could see, I don't think that there's much of a coincidence that right after that, when the market reopened that night, Thursday night, Trump imposed 35% tariff on goods from Canada, and the market came off. So that could have been someone front running that news, right? Who knows in the Trump market, right? There's a lot of things going on behind the scenes there. So that's that. One other thing, and this is key, especially this week with Vixperation and OpEx, is the fact that VIX, the seasonality of the VIX tends to bottom in the third week of July. And this data stems from, this is a 20-year range, okay? So in the last 20 years, right, you could see that the third week of July tends to bottom in the VIX. So will that happen again? Who knows? But it certainly does not hurt to be aware of this information. So McElligott from Nomura said, we head into July OpEx overlapping with the earnings buyback blackout window in this fresh systematic positioning rebuild, which could then act as your primary de-risking flow into a spot sell-off and vol squeeze. So basically he's saying that, you know, if the vol does squeeze, it'll cause a de-risking flow in the S&P 500, S&P going down, VIX going up. So these are all things to keep an eye on, and there's some setups that I am looking at going forward. I went over with the Academy members, but one thing that I am looking at, I'll share it publicly, is this, right? So July VIX goes off the board on Wednesday morning, and then we will go to the August contract. So August last week bounced off of 18, or call it 19.0, which was the lows back in March. Okay, you could see it double bottomed at that that previous swing low. So I am looking at potentially taking longs in the VIX against that 19 level with a stop loss below that, if I see the opportunity present itself. Okay, so that's basically what I'm looking for, as well as some other things, but I'll keep it at that. But again, those are the key areas that I recommend looking at. Those are the key events that I recommend watching out for. And one last thing for the people that stay to the end of the video, Goldman 2 weeks ago posted in one of their newsletter, quote unquote, we see the peak in the S&P around the July 17th date, followed by a leg lower. Will they be correct there? I don't know, but definitely keep an eye on that date, which is in 3 days. Peace.